Before I explain the format and introduce our moderator, we're going to hear very briefly from a very special guest, Dr. Timothy McNiff. And to provide context for his remarks, I wanted to share with you the threefold mission of the Catholic Finance Association. The first of those missions is to grow in our faith and understanding of Catholic social teaching. Number two, to engage and implement that teaching within the finance industry. And finally, to offer service to the church with the knowledge and expertise we as Catholic finance professionals possess. And it is that last feature that I think is a perfect segue for Dr. McNiff's remarks here this evening. He's going to be sharing with us an opportunity which finance professionals here in the city can help the schools of the Archdiocese of New York. Dr. McNiff.
Thank you, folks. He said brief, right? You know, I've learned something. The best talks have an insightful beginning, a thoughtful conclusion, and the two are as close together as possible on that. Here's the good news. My comments today are not directed at your pocketbook, but they're directed at your mind and your heart, because I'd like to talk about commitment. You may have heard the story where the chicken and the pig are talking about their participation with breakfast, and the pig says to the chicken, you know, it was nice with your participation, but that was a contribution. For me, that was true commitment with the bacon and eggs. And I share that with you because we've got a lot of exciting things happening with our Catholic school system in this archdiocese. We have completely revamped our governance and our business structure. May I just say that while we have had some struggles and made some incredibly tough decisions because of mounting deficits, they were deficits because 65% of the children in our school system in the city live at or below the poverty line. 97% of them go to college. It's a great story. What's happened in the classroom is terrific. But we have a rotten business model, and that's what's been challenging us. So I come to you today with one comment about our school system. We're fixing it through a governance program. We've begrudgingly have said pastors and parishes can't do this anymore. And we are inviting now as many professionals in our communities to say, would you come in and help us run this car? Grab the keys and help us run it. We've created regions that have boards in them, 9 regions, and we've incorporated them. And we're looking for people with finance, marketing, building facilities, development, PR, all of these things that I'll call our torpedoes that have been sinking our ships. That's where we've been lacking. And so today, if you're so inclined, and I'm going to leave a one-page flyer in the back here that gives a little bit more information. I'm not looking for donors. I'm looking for committed people who believe in Catholic education, who've got the financial and business acumen up here and a heart for the schools that say, can you donate your time and participate on either a regional board, or then we get very personal and we set up advisory boards for each one of the schools. We call them champions, where you marry with the principal to help create a budget, maintain a budget, look at the building and the facilities, the marketing, the recruitment and all. This is where we need our help. So if my quick comments today resonate with you and you feel you have the time, would you please just give us a call? We'd love to chat with you, do a little bit deeper dive on what we're looking for in terms of this type of a commitment. And for anything that you can give to us, please know of our appreciation. But I'll close with saying this to you. This is a great school system. It's doing God's work. We're making great citizens when they leave us, and we're going to be here for a long time. So if any confidence has been shaken the last couple of years because of so many school closures, we're finished. We've solidified it, and now we're bringing more people in. We got the right money, and now we need the right intellectual capacity to help us. Give it some thought. Thank you so much for your time.
Thank you, Dr. McNiff. I think it's a wonderful opportunity. We actually had the chance to discuss this in advance of tonight's event, and I think it's just an incredible opportunity to apply the things that we talk about here, because as important as it is to get into the intellectual and have those discussions, it's also equally important that we find practical applications for the kind of God-given skills that we have in the finance world. And this is it can't get any more specific than getting onto finance boards and to help take the money that's already been contributed to the Archdiocese and make it work more effectively. So hopefully, for those of you that feel called to do that, you'll pick up those forms and get in touch with Dr. McNiff. And just before I introduce our moderator, I want to explain kind of the format for this evening. So what we've got is we're going to allow Mike Connor to introduce our speakers and introduce and provide some opening remarks. We're then going to hear from each panelist, and they're going to use some slides as necessary to kind of further their talking points. We're then going to have the first of two opportunities for you in the audience to participate. And that's going to happen right after their opening remarks, is for you to offer some other opening comments. If there's something that's on your mind, if there's something that perhaps you'd like to supplement to some remarks they've made, it's not necessarily for questions just yet, because we'll have that at the end and plenty of time for it, but just about 4 or 5 minutes of additional comments right after their opening remarks. We'll then go to rebuttals from each of the panelists, and then our moderator is going to manage or to moderate a discussion amongst the panelists, and then we will open up for Q&A. So I think it's going to be a fantastic event here this evening, and to lead that discussion is Mike Connor. Mike is the CEO of Market News International, a global financial news and analysis company serving capital markets professionals, particularly in the foreign exchange and fixed income markets. And it is a wholly owned subsidiary of Deutsche Börse. Is that how I pronounce it? I'm sure all of you would have corrected me had I, or was it Burka? Börse? You got it. Börse. Got it. Burka would be something different. Notably, they have over 80,000 subscribers, and they've been around for over 25 years. So Mike Connor is going to be a great moderator for us tonight. Mike.
So I've run a financial news company for quite a few years now, and I've had my chance to see all different types of reporting. But how's this for a bit of unbiased reporting? A recent Financial Times business report entitled, "Are All Bankers Going to Hell?" led with the question, is it easier for a camel to pass through the eye of a needle than a banker to get into the kingdom of heaven? So we're working against the odds here. I'm sure many of you saw the Andrew Ross Sorkin piece in the New York Times 2 weeks ago, which bore the title, "On Wall Street, a Culture of Greed That Won't Let Go." The focus of this article was a survey, which was recently conducted by the law firm of Labatt & Sucro. Some of the results of the survey are very troubling. Just to mention a few, 23% of respondents indicated that they had observed or had firsthand knowledge of wrongdoing in their workplace. 29% of respondents believe that financial services professionals may need to engage in unethical or illegal activity in order to be successful. 24% of respondents likely would engage in insider trading to make $10 million if they thought they could get away with it. And 28% of respondents felt that the financial services industry does not put the interest of clients first. In addition, for almost every question asked in the survey, the results were worse for participants who have been in the industry for 10 years or less, which would seem to imply that the future may be far worse than the present or the past. The executive summary of this report states that it covers, quote, it uncovers, quote, an abject decline in three forces that individually and together have the power to serve as safety nets for the economy: individual integrity, leadership, and corporate culture, unquote. I mention all of this not to promote this particular report, although it is very thought-provoking. The timing of its publication is good for setting up this session tonight. Since the outset of the financial crisis, the public has been subject to a constant barrage of news about the bad actors in financial services. Bailout money to pay bonuses, MF Global, the London Whale, LIBOR fixing, insider trading arrests and indictments. Are these types of episodes hardwired into the culture of greed and manipulation? Has it gotten worse, Or was it always like this and we're just paying more attention? Does the good that come out of financial services, which somehow rarely makes the headlines, outweigh the bad? We have three experienced, knowledgeable, and very, very involved panelists here tonight who will give you food for thought on these and other questions. And it's my pleasure to introduce them to you now. Carla Harris is Managing Director and Senior Client Advisor at Morgan Stanley. In her current role, she is responsible for increasing client connectivity and penetration across the firm's securities and wealth management businesses. Throughout her career at Morgan Stanley, she has headed the equity capital markets effort for the consumer and retail industries, was responsible for equity private placements, and was a senior member of the equity syndicate desk, where she worked on transactions such as the IPOs for UPS, Martha Stewart Living, and Delphi Automotive. Ms. Harris has been the recipient of a long list of prestigious awards and recognitions, such as being selected to the Fortune's list of the 50 most powerful black executives in corporate America, U.S. Banker's top 25 most powerful women in finance, Essence Magazine's list of the 50 women who are shaping the world, and Ebony's list of 15 corporate women at the top. She is the author of the book Expect to Win, and also has a successful singing career, having released 2 CDs of gospel music and a CD of Christmas music. And by the way, there's a great song called Expect to Win on her most recent CD, which fits in the book really nicely. So you might want to go for the dual deal from Amazon.com. Carla is the chair of the board of Morgan Stanley Foundation and sits on the boards of numerous foundations and nonprofits and charities. She received her AB from Harvard University and her MBA from Harvard Business School. Please welcome Ms. Carla Harris. Mr. John Mueller, to my far right, is the Lehman Institute Fellow in Economics at the Ethics and Public Policy Center and president of the economic and policy analysis and forecasting firm LBMC LLC, both of which are located in Washington, D.C. He is the author of Redeeming Economics, Rediscovering the Missing Element. Mr. Mueller has advised American and international economic policymakers on monetary, tax, welfare, and Social Security policies since 1979. He was staff economist to then Congressman Jack Kemp from 1979 through 1988, before and during both Reagan administrations, mostly as economic counsel to the Republican Party caucus in the U.S. Congress, while Mr. Kemp was chairman of that caucus. In that capacity, he drafted bills originating some key features of President Reagan's Tax Cuts of 1981 and Tax Reform Act of 1986, and of Mr. Kemp's presidential campaign in 1988. Mr. Mueller is a senior fellow of the Lehman Institute, a member of Princeton University's James Madison Society, a Jack Kemp Foundation Fellow, and Senior Fellow of the Intercollegiate Studies Institute. Mr. Mueller specializes in the relation of modern economic theory to its Judeo-Christian and Greco-Roman origins, its practical application to personal, family, and political economy, and the interaction of economics, philosophical worldviews, and religious faith. He's a graduate of Haverford College. Please welcome John Mueller. Then last but not least, and going to lead off our opening remarks, is Ethan Garber. Ethan has over 20 years of experience as a turnaround investor and more recently as a social entrepreneur. He started his Wall Street career in the loan workout group of Chase Manhattan Bank. That was the original Chase, pre-chemical, pre-JP Morgan, but not, there's several different layers of family there. Followed by several years as an award-winning distressed debt researcher at several firms, including Lehman Brothers and Jefferies. From 2001 to 2008, Ethan co-managed a $1 billion proprietary structured hedging portfolio at both Bear Stearns and Credit Suisse, where he served on numerous credit committees of corporate restructurings. From 2008 through 2010, Ethan was a settlement negotiator for the liquidation of Lehman Brothers' derivative estate. In 2010, he led a group of investors to purchase the assets of IdleAir out of liquidation. IdleAir operates the nation's largest truck stop electrification network, providing a clean, efficient energy alternative to diesel truck idling for thousands of truck drivers and trucking fleets on major highway corridors. Since 2011, Ethan has been the CEO of IdleAir. In addition to IdleAir, since leaving the street, Ethan has been an investor and entrepreneur in other businesses with a focus on environmental purposes. Ethan graduated from Wesleyan University with a degree in religious studies. How he ended up in finance, we're not quite sure, but I'm going to turn the mic over to Ethan. I'm sure he'll explain it all to you. Ethan Garber.
A quick snapshot about my background so that you don't think that I was a plant here to undermine the evening. My first interview on Wall Street after losing my first job on a trading desk because the trader couldn't read my handwriting and bought the wrong stock. I interviewed at Chase Manhattan Bank. I was lucky to have an interview with a gentleman who was comfortable telling me that he was born again. So that led me to want to ask him, can you be ethical on Wall Street? I just wanted to get a job, but I also was curious and thought that that would help. And he was thoughtfully confused, and then he wasn't quite sure how to answer the question. He said he wasn't sure. And I got hired. After a couple of years working as an analyst slave, I picked up exposure to bond trading and ended up in the workout group at Chase, which was fun. We got to see the remains of things that had either taken on too much debt or had some misfortune, and the bank was trying to be opportunistic then, but also be careful to not seem too opportunistic. And then, as Mike mentioned, Chemical Bank bought us, and everyone was fired except for me and my boss. So after that, I went to the trading desk of a company called Jefferies. Jefferies is now a legitimate, they were legitimate then, but they're the fourth largest investment bank. But at the time, I was the desk analyst for the junk bond trading desk, and everyone there had a badge of honor, which was they had all worked for Michael Milken. And their kind of proud achievement was that they understood certain machinations of the markets that maybe others were more embarrassed or uncomfortable to embrace as quickly. So I had a lot of fun. I learned a lot. In retrospect, although it was good for my career and very educational, and I developed a lot of relationships, there's definitely things that being on a trading desk, I'm embarrassed that I did. And I think if, as a buy-side customer later, I would hang up the phone on someone if I knew that they were part of the kind of confusion that's sometimes a critical element in the trading environment. It doesn't have to be that way, and there are rules to keep it within parameters that are perhaps manageable. But these are facts that percolate throughout all industries, not just finance. So the statistics that Mike talked about that are a bit disappointing, I don't think that we should be ashamed of finance, but we're all human, and there are a lot of factors that influence lots of decision-making. It's important for us to be responsible and try to have a patient, calm moment where you can think about what the implications of what you're doing are. It's not always easy. So the question tonight, I guess, is about, has the culture of Wall Street changed? And I didn't quite know how to answer that question when I talked to Mark and Jeff. I think it has. I'm a bit of an outsider. I'm now a refugee from Wall Street, having been at Bear Stearns on St. Patrick's Day when it closed. So I then did work at Lehman Brothers, where I got to see the kind of fallout of large financial implosion. And we got to see the uneven, arguably unfair treatment of different creditors and stakeholders and institutions that was a kind of consequence of the magnitude of the financial crisis, but I would argue also a consequence of the sometimes arbitrariness of the government choices on how to handle the bailout. And I don't pretend that I could have done a better job, but it's easy to see It was somewhat easy to see during the crisis, and it was even easier to see afterwards that there were choices that were made that affected the restructuring of the financial system that were not always the best choices, weren't even close to the best choices, and weren't the only choices. So has the culture changed? I think it has changed. I think it's become more muted. It's become more humble. Certainly from a PR standpoint, that's the way management has conveyed the change in Wall Street, and that's good for handling this kind of a climate and environment. Sometimes senior management can get egg on their face when they suggest that they're the best risk managers institutionally, and then they have a $100 billion trading book that they forgot that they had, or that was maybe in another continent. So I worked at that institution, and I worked at, as Mike mentioned, structured hedging. We made up that name. I was in the credit derivatives business. It was just an excuse to make a lot of bets. Fortunately for me and my friends, they were successful. I think we were prudent risk takers. And I think as the culture has changed, what's changed is that there is less risk taking. There's less diversity of risk taking. There's less of a celebration of best risk selection, perhaps. But that's not all negative. Perhaps the financial industry shouldn't be as levered and as big and as broad in making risk decisions that might be more appropriately handled by not banks or not investment banks. I was at an institution that was 40 times levered. I didn't know that. We were there. We came in every day. I had no idea. That was foolish on my part. So the culture's changed, and I think some of that's good. The size of the financial industry has shrunk. The financial industry, I think, as a percent of GDP, has gone from 2 or 3% before deregulation in the early 80s to close to 10% at the peak in 2007 or 8. I'm sure that Jim and others can correct some of these stats. But I'm not sure that the role of the financial industry as intermediaries of finance, as service providers to the rest of society, has to be absolutely the largest industry, or that there's no limit to what its scale should be. And when it gets reined in some, it might be healthy for society, and also even for the participants, at least the participants that keep their jobs in the industry. Because having a potential sense of entitlement from simply being successful and making the mistake of thinking that you're successful because you're special is an easy mistake to make, especially in finance, because we can get paid so much. And it's sometimes healthy to have that ratcheted back. So that is one thing that's changed. Another thing that's changed, I think, in the culture of Wall Street is that Wall Street's not just smaller, but a lot of the people that were in Wall Street aren't in Wall Street, not often by choice, sometimes by choice. And that might be healthy for society, and it might even be healthy for those individuals. There are a lot of statistical studies, not the one that Mike reported, but another one recently that we have a video of, but there may not be time for, that suggests that as people earn less money, they become nicer, they become more generous, they become more patient. And although these aren't universally applicable principles, they're interesting side effects that might be informative and something to have a positive sense for. So the question of whether it's changed is interesting. My first reaction was, can you quantify how it's changed? Are people more charitable? How do we know that the culture's changed? Are there now ethics committee meetings every time someone wants to do a banking deal? Do traders on the desk hold hands and ask, should we do this? Is this right for our clients? Are those the changes that are happening in the culture? Or is it generally a deleveraging that just leads to less froth, and the banks are a little bit bigger, the hedge funds are a bit bigger, investment bets are a bit bigger, and therefore there's sort of a gap in financing. If you're a big company, you can get cheap capital. If you're a small company, it's more difficult. I'm not sure what some of those changes are, but it would be interesting to see how much self-introspection there is. Is there an index that you can measure that's part of the cultural change potentially, or charitable giving on an absolute sense? At Bear Stearns, I'm proud to say, it was the only investment bank I ever worked at where they required all managing directors to give 4% of their gross pay to charity. They had to prove it. I think that's a good cultural trend. Maybe that should be one of the cultural changes that we have. Maybe that should be mandated by the institutions. Maybe another change that can be done that is will have an pervasive and positive effect would be something as simple as making sure that mortgage loans can't be more than, say, 80% of loan to value. This could change a large dynamic of the excesses that are likely to happen again with a very stimulatory climate supported by the government. Perhaps institutions should have mandatory volunteer work, not just give to charities to get good PR, to say, hey, we supported these great charities. Make your employees do it. Sacrifice your P&L for a week or a couple of days and make your employees be involved and part of it. Those would be incremental positive changes to the culture that would only add to what's already been positive. Thank you.
Okay, the question at hand, has the culture on Wall Street changed? And for me, the answer is a resounding yes. I've had the privilege of working in this industry for 26 years, and I've worked in M&A, I've worked in capital markets, I've worked in asset management, and obviously seen a lot of cycles, seen a lot of people, and seen a lot of stuff happen over 26 years. But I do think that there are at least 3 things that are markedly different than pre-2008. The first one, obviously, is a focus on transparency, obvious transparency. Everybody's talking about it. The word is in every sentence. And I think the firms are going above and beyond what they used to in making sure that there's transparency with their shareholders, there's transparency with their employees, and there's certainly transparency with the regulators. The second thing that I think has happened is a shift in terms of the relationship orientation. When I started in this business in 1987 as a wee child, I will tell you that people talked about this being a relationship-oriented business. And then within a year or so, and that was back obviously the late 80s, you recall that M&A was hot, hot, hot. Then people talked about it being a transactional kind of business. You didn't hear as much about the relationship. And then by 1989, which was the big year in M&A at that time, over that decade, 1990 happened and M&A was not hot. And 1991 happened, it was not hot squared. It was nothing going on at that point, and then you started to hear more about relationship orientation, and then here comes the 90s with a robust bull equity market environment, and then you started hearing more about the transactional nature of things. And I think we sort of carried on that way through the decade of the 90s until 2001, when 9/11 stopped us all and made us take a pause, and there was obviously a pause in the market in 2002, 2003, and 2004, and then the engine started to rev up again. I think what has happened, obviously, since post-2008 is that the pendulum has really swung all the way back to a relationship orientation, but it's not just about the customer relationships anymore. Now it's about your relationships with the regulators and your relationships with the rating agencies, which I would argue you didn't hear a lot about that kind of conversation back in the 90s, back in the 80s, but it is something that the firms have to pay attention to if they expect to compete at all in this kind of environment. And I think the third thing that has happened, and alluding to some of Ethan's comments, is that firms are now very, very focused on who they are in the world. So while he talked about it would be nice if you force your employees to do more charitable work and have a greater amount of philanthropic giving, I would submit to you that there was a lot of that already going on Wall Street, but it was not something people talked about. It was not something people underscored. It certainly was not something they advertised. And obviously witnessed what has transpired in 2009 and 2010, 2013, with firms talking more openly about who they are as a corporate citizen in the world and the kind of giving that they're doing, and creating programs where employees can give back, and actually creating competitions to see how many hours they can log in a certain month or in a certain year in terms of their charitable giving. There's always been some individual giving and there's always been some corporate giving, but I think now there's a consciousness that it's not just about making money, it's also about trying to create a multiplier effect about who you are in the communities where you do business. So I think that some of the changes that are here to stay are certainly this point of transparency. I don't think that goes away. And again, not just transparency with the regulators, but also transparency with your customers and transparency, obviously, with your employees. Wall Street is being faced sort of subconsciously and consciously with a challenge of getting the best and the brightest, not just because of what has happened with the 2008, 2009, but because the next wave of professionals care a lot more about than just the money and just the title. A lot of the millennials are focused on, well, who else am I going to be, and what kind of platform do I have, and what are you offering me as a company, as an industry, as a platform and an opportunity to do good in the world. So away from what has happened with the crisis, there is a necessity now, if you want to be able to attract the best and the brightest, that you have to create a platform. You have to be the kind of firm where people can not only do the work, but they also have an opportunity with hours, with money, with time, with who they are in terms of the whole person to be able to give back. So I think that is a positive change, and I think because of the generation of professionals that are following us, that's also going to be something that's a necessity and that will definitely stay. No question, I agree with you that the focus on risk and the focus on leverage has changed things. I don't think, and I'm generally a bull, but I don't think we go back to what we saw in the 90s. I don't think we go back to what we saw in the early 2000s in terms of the level of risk-taking and the level of leverage that all the firms put on. So I think that's gone. I think you will see a more measured approach. Now, we all know that the street is resilient. So no matter what exogenous shock happens to the marketplace, the street always figures out a way to continue to compete, to continue to do business. But I don't think that you will see us go back to the levels of irrational exuberance that you saw from the service providers or the investors at that time. So I'm pretty bullish, again, on who we are as an industry and our ability to be able to compete and compete successfully. Now, obviously, everything that has transpired with some of the things that Ethan alluded to in terms of, you know, the incidences that happened with LIBOR or some of the other things that Mike talked about at the outset, I can't think of an industry, frankly, where you don't see some of those things happening. But we are now in a 24/7 news cycle, and so all of that gets magnified in a way that you didn't see it magnified 20 some odd years ago. I started, as I said, on the street in 1987. The crash happened October 19th, and it wasn't long after that before there were big headlines about Milken and Bolsky. But even then, as sensational as that was, it did not compare to what happened in 2008, 2009, and with some of the individuals who were involved. So I think that also makes us have an obligation and a requirement to be a lot more careful about what we do, because one individual can potentially damage your franchise in a major way, in a way that it couldn't, I would argue, 20 years ago. And lastly, what I will say is that I think because of who we are now on the street and the regulatory environment and how we must compete, again, if we want to compete for the best talent and if we want to compete in this regulatory environment, I do think that it's going to change the kind of people that come to the street and frankly the kind of people that we screen for. I would argue that back in the 80s, you were really looking for somebody who had that fire in the belly. I remember hearing that over and over when I was recruiting for the street. But I think now people are really trying to figure out who is the person. What is your measure of integrity? Can I trust that you're not going to go off and do something that, again, could impair or bring down my franchise? So I think there's a slightly different lens as we recruit at the undergraduate level, as we recruit laterally, and as we recruit coming out of business schools now that will make for long-term positive change on the street. So that we can keep our conversation, I will stop there and turn it over to Mr. Mueller.
I can agree in part with the other two panelists. In fact, having seen Carla Harris in action before, I'd like to bottle what she has to offer. But I'm afraid that I can't offer inspiration. Daniel Kahneman, who, though a psychologist, won the 2002 Nobel Prize in Economics for helping to pioneer the study of cognitive biases, explained, when the handsome and confident speaker bounds onto the stage, you can anticipate that the audience will judge his comments more favorably than he deserves. The availability of a diagnostic label for this bias, the halo effect, makes it easier to anticipate, recognize, and understand. Because of multiple sclerosis, I regret that I cannot no longer bound onto the stage. And my effectiveness as a public speaker has been undermined by some annoying quirks that may make me sound like I began the happy hours earlier than most of you. It's a kind of an anti-halo effect. Here at the Catholic Finance Association, I plan to speak partly American, partly Wall Street, and partly Catholic. Has the culture of Wall Street changed since the financial crisis of 2008? My answer is emphatically not. The reason is that culture does not occur in a vacuum. And the crisis of 2008 itself, like every major American financial crisis, going back at least to the Great Depression, was caused by a monetary peculiarity which warps the incentives at both ends of Pennsylvania Avenue and here on Wall Street. To put it in American, there are 4 principles of all successful American economic policy, and the first was established by Alexander Hamilton, acting as our first Treasury Secretary under George Washington, both of whom had recent bitter experience with the feckless Continental Congress and colonial governments. That first principle of successful American finance is don't print money to finance the federal budget. As Mike mentioned, I've made my living since 1988, mostly by predicting the economic and financial market carnage that results when monetary authorities ignore this first principle. Justin, could we have the next slide? By comparing the change in the total official monetary liabilities with the rates of inflation or deflation in the U.S. Consumer Price Index or the Case-Shiller Index of home prices, it's possible to see that every major inflation or deflation of the CPI or of housing prices was preceded by a commensurate expansion or contraction of this measure of high-powered dollars, which I call the world dollar base. Justin, could you hit the next slide as well? Also, the U.S. stock market performance is systematically related to the ratio of American producers' selling prices to their input costs. Rather than congratulating myself on having figured that out, I find it a disgrace that I can make a living by predicting what bad things will happen in the U.S. economy and the U.S. financial markets. Now we'll switch to talking Catholic. The monetary arrangement I have just described qualifies as what Pope John Paul II in one of his social encyclicals called a structure of sin. In fact, the great French economist Jacques Rueff called it the monetary sin of the West. My friend and business partner, Louis Lehman, was Rueff's American protege, and he described the results this way earlier this year at the Grants Conference. These are his words. Over many inflation cycles, the social effects of financial disorder and undervalued currencies have brought about increasing inequality. The near zero interest rates, now maintained by the Fed, have primarily benefited preferred banks and their financial clients. A nimble financial class in possession of cheap credit can maneuver to protect itself against inflation. But the vast population of middle-income professionals and workers on salaries and wages, and those on fixed incomes and pensions, are impoverished by this same volatile inflationary process. Inequitable access to cheap Fed credit was everywhere apparent during the government bailouts of favorite bankers and brokers in 2008 and 2009. Ethan referred to that. While millions of not-so-nimble citizens were forced into bankruptcy. He concluded, this ugly chapter is only the most recent in a very long century of disruption of the international monetary system. I noticed that a recent talk by Carla Harris appeared under the headline, Chaos Breeds Opportunity on Wall Street. Now, I know she can't be held responsible for the headline, but I think it does say something important about the state of affairs here on Wall Street. Well, yes, chaos does breed opportunity on Wall Street, but it also breeds chaos on Main Street. The next graphic summarizes a recent survey on American household finance published by the Federal Reserve Bank of St. Louis. As you can see, it shows total net wealth, but divides it by the sources of that wealth, including stocks, which tanked in 2008, but have recovered roughly to their previous place, but also real estate, which peaked in 2006 and has really stopped declining. So most American families fortunate enough to have stayed invested in the stock market have recouped their losses, but the families whose main asset is their home, if they still have one, have not. So I must part company with anyone who suggests how great things are and assures us that apart from a few bad apples, Wall Street is maintaining a high ethical standard. The current system is a machine for manufacturing bad apples, people behaving badly at both ends of Pennsylvania Avenue and on Wall Street.
Mr. Mueller, can you please comment on inflation side? It looks like you strictly against it, and there are a lot of view about it that inflation should be at 4% at least, otherwise we run into stagnation like in Japan case, and also having such a big housing market underwater, it's much more plausible to have inflation because people have less debt over the time. Can you comment on those two sides of inflation? And in my understanding, it has to be expected, it has to be manageable, otherwise we get into stagnation if we bring it down to zero.
This shows the consumer price index going back to 1774. As you can see, there have been a lot of spikes in the price index, mostly associated with wars, like the Revolutionary War or the Civil War. But under the classical gold standard, which existed from 1879 to 1914, notice that the price level was exactly the same at the end as at the beginning of that period. And its maximum variation during that time was from 24 to 29, which is a little over a 20% rate of total change in that 40-year period. Since then, we've had several changes of monetary system. The most volatile was between the First and Second World Wars. There was somewhat more stability in the sense that there was a slower rate of inflation under the so-called Bretton Woods system from 1944 to 1971. But since we've been on an international paper dollar standard, namely since 1971, the price index has roughly quintupled. And so this suggests to me that the laboratory of history shows that we can do an awful lot better than we have done of late. So I don't think we need to accept, say, a 4% inflation rate as a good thing, or good even in relation to what we've accomplished in the past. I think if we do, monetary policy is really not rocket science. If we follow the principles upon which our system were set up by Alexander Hamilton, we could once again have the same sort of stability that we had before this most recent volatile period.